They've done this 3 times now: 1980, 2011, 2026. Same playbook, same weapon, same result. On January 30th, silver crashed 37% in a single trading day, from $121 to $75. 6 hours, no catalyst, no news, no explanation. And if you know the pattern, you saw it coming. I'm going to show you exactly how they did it, why they keep doing it, and what it means for your money. Welcome to the Wealth Continuum, where we connect the dots between markets, money, and the forces that shape your financial future. I'm here to help you understand what's really happening beneath the surface of the financial world. If you're new to the channel, hit that subscribe button now. We analyze the patterns the mainstream media won't show you, and today's episode is one you absolutely cannot miss. If this analysis adds value to your understanding, please like this video. It helps us reach more people who need to see this information. Let's talk about what happened on Friday, January 30th, 2026. A 37% crash in silver in a single trading day. No major news, no crisis announcement, and no catalyst that anyone can point to. Just pure, systematic destruction of value. Here are the numbers. Silver was trading at $121 per ounce Friday morning. By market close, it had crashed to $75. That's $46 erased in just 6 hours of trading. Gold fell from $5,600 to $4,700. $900 gone in the same time frame. This wasn't a crash. This was an execution, a controlled demolition of a market that had gotten too successful. And I'm going to show you exactly how it was done, why it's happened before, and why it will likely happen again. This isn't the first time. In fact, it's the 3rd time in 50 years that we've seen this exact playbook executed. Same strategy, same tools, same devastating results. Let me walk you through the history. In 1980, silver rallied from $6 to $50, an 800% gain in just a few months. Regular investors were accumulating wealth in precious metals, converting their paper dollars into real, tangible assets. The response was swift and devastating. The CME created Silver Rule 7, which effectively banned leverage buying overnight. You could still buy silver, but you had to pay 100% cash up front. No margin allowed. That same month, the Federal Reserve Chairman Paul Volcker raised interest rates from 11% to 20% in a single move. The result? Silver crashed from $50 to $10, an 80% destruction of value. It took silver 31 years to revisit the $50 level again. Fast forward to 2011. Silver ran from $8 to $50, a 600% gain. Retail traders were flooding into the market. Banks holding massive short positions were under extreme pressure. What happened? The CME raised margin requirements 5 times in just 9 days. That's an 84% increase in the collateral needed to hold positions. Each hike forced more traders to either deposit more cash or get liquidated. These margin hikes happened while silver was still rising. They created the fall. Silver crashed from $50 to $26, losing 50% of its value in weeks. It took 13 years for silver to recover from that crash. Now, here we are in 2026. Silver rallied from $26 to $121, a 450% gain, the biggest rally in modern history. Social media was exploding with success stories. Regular people were making life-changing money. The response? The CME raised margin requirements 4 times in 6 weeks. The result? A 37% crash in a single day. The fastest destruction of the 3 times in 50 years. Same setup, same mechanism, same outcome. At the Wealth Continuum, we believe that once is an accident, twice is a coincidence, but 3 times is a pattern, and patterns reveal intent. Let me take you through Friday, January 30th. This was the last trading day of January. Silver was sitting at $121 per ounce. January had been the best month for silver in decades, 65% gains in just 30 days. Analysts were projecting $200 silver by summer, even $300 by year end. Social media was euphoric. Everyone believed they'd bought at the right time. The fear of missing out was at peak levels. Then 9:30 a.m. Eastern Time hit. The New York market opened. Within seconds, a tsunami of sell orders flooded the market. This wasn't retail traders taking profits. These were institutional scale sell orders, massive blocks. Millions of ounces being dumped simultaneously. The kind of coordinated selling that doesn't happen by accident. Silver dropped from $121 to $150, then $110, then it broke below $100. That psychological level everyone said would hold forever. The support was gone, blown through in minutes. Then came $95, $90, $85, $80. Stop losses were triggering everywhere. Margin calls were flooding trading desks. Traders were being liquidated whether they wanted to sell or not. By market close, silver was at $75. Gold was at $4,700. In 6 hours, hundreds of billions in value had been erased. I watched it happen in real time. I watched fortunes disappear. The question everyone was asking, what happened? What changed? The answer from the financial media was nothing, just a correction. Markets got ahead of themselves. That was the cover story. Here's what actually happened. Watch what happened in the 60 days leading up to Friday's crash. Pay close attention to the dates. December 12th, silver is surging. The CME group raises margin requirements by 10%. It barely makes the news. December 29th, silver keeps climbing. The CME raises margins again, a 25% jump overnight with no warning. December 30th, the very next day, they raise margins again, 2 hikes in 2 consecutive days. That almost never happens. January 28th, just 3 days before the crash, they changed the entire system, moving from fixed dollar amounts to percentage-based margins. The rate jumps from 9% to 11%. For riskier accounts, it goes to 12.1%, 4 margin hikes in 6 weeks. An 80% total increase in the collateral required to hold silver positions. Here's what that means in practical terms. Margin is the cash you need in your account to hold a futures position. When margin requirements increase, every trader holding a position suddenly needs more cash, not next week, immediately. And if you can't deposit that extra money within hours, your position gets liquidated, sold, no negotiation. You're forced out. Imagine your landlord calling and telling you your rent just went up 80%, and you have until tonight to pay or you're getting evicted. That's the call that went out to every silver trader at the same time over those 6 weeks. Most people don't have that kind of money sitting around, so they get liquidated, forced to sell. And when thousands of leveraged traders are forced to sell at the exact same time, the price doesn't just decline, it collapses. This wasn't the market finding fair value. This wasn't a bubble popping naturally. This was the CME pulling a trigger they've pulled before. The real question, the question that matters more than any other, is this: why? Why does someone care this much about crushing silver? Why coordinate these margin hikes? Why deploy this playbook 3 times in 50 years? The answer has nothing to do with silver itself. It has everything to do with what silver represents, what it threatens, what it exposes about our entire financial system. This is fundamentally about the dollar. The United States has one superpower that no other nation on earth possesses: the world reserve currency. This is the ultimate financial weapon. Every country needs dollars to buy oil. Every country needs dollars to trade internationally. Every central bank in the world holds dollars as reserves. This reserve currency status is why America can print trillions of dollars and still survive as a functioning economy. This is why the government can run $30 trillion in debt and just keep spending more. This is why we can have massive budget deficits year after year without collapsing. Because the world has no choice. Everyone needs dollars. Everyone has to participate in the American financial system, whether they like it or not. But something is changing in the global financial system, and it's changing fast. Central banks around the world bought more gold in the past 2 years than in any comparable period in modern history. They're not buying U.S. treasuries anymore. They're actually selling them. They're diversifying away from dollar-denominated assets. They're reducing their dollar exposure. They're protecting themselves against inflation, against monetary debasement, against the consequences of unlimited money printing. And silver? Silver is gold's little brother. It's the poor man's gold. It's accessible, it's affordable, it's real money that average people, middle-class families, regular workers can actually accumulate. When silver rallies 450% in 14 months, when regular people start making serious money in silver, when they start converting their paper dollars into physical metal, it sends a very powerful message to the system. That message says, we don't trust your paper anymore. We don't believe in your promises. We don't think the dollar will hold its value. We want something real, something tangible, something that can't be printed into oblivion by central banks. That's the threat. That's what silver represents. Not just an inflation hedge or a commodity investment, but a vote of no confidence in the entire fiat monetary system. Every ounce of silver purchased is a dollar that's been rejected. Every silver coin in someone is safe is a statement that says, I'd rather have metal than your paper promises. And when millions of people start making that statement simultaneously, when the exodus from dollars into hard assets accelerates, the entire system comes under pressure. The authorities can print unlimited dollars with the push of a button. They can manipulate interest rates. They can intervene in bond markets. They can bail out banks. They control the exchanges. They control the rules. They control the regulatory framework. They control the entire game. But there's one thing they cannot control: physical silver. Physical silver can't be printed. It can't be created out of thin air. It can't be margin called. It exists in the real world, completely independent of their control. When you hold a physical silver coin in your hand, nobody can margin call it away from you. Nobody can change the rules overnight and force you to sell it. Nobody can devalue it by printing more. It's yours, it's real, it's permanent. What we have now are 2 markets, 2 prices, 2 realities that are diverging more and more every single day. There's the paper silver market, futures contracts, ETFs, derivatives, promises on computer screens. And there's the physical silver market, actual metal, actual coins, actual bars. And these two markets are telling very different stories. Here's what makes this whole situation so fascinating from a geopolitical perspective. While America was panic selling on Friday, while American traders were getting liquidated left and right, while the paper price was crashing at 37%, China was buying physical silver. Shanghai vaults drained 27 tons of silver in a single day last week. Not sold back onto the market, removed from the vault entirely. Physical delivery to buyers who wanted the actual metal in their hands, not a paper contract, not an ETF share, but actual silver bars. This has been happening for months now, actually for years if you look at the long-term data. While Western investors trade paper contracts back and forth, speculating on price movements, Chinese buyers keep taking physical delivery. The vaults keep draining. The metal keeps flowing from west to east, from New York and London to Shanghai and Hong Kong. Think about what this means. America dumps paper contracts, crashes the paper price, and congratulates itself on managing market volatility. China says, thank you for the discount, and takes delivery of the actual metal at bargain prices. One side is trading promises and IOUs on computer screens. The other side is loading trucks with actual bars of silver and moving them into secure vaults. Which side do you think really understands what silver is worth? Which side is playing the long game here? Which side is accumulating real wealth versus which side is trading pieces of paper? This is one of the most important wealth transfers happening in the world right now, and almost nobody in the Western financial media is talking about it. Physical silver is moving from west to east at an accelerating pace, and every time there's a paper price crash like we saw on Friday, it accelerates even more because Asian buyers see it as a buying opportunity, not a reason to panic. Here's what's crucial to understand. The fundamentals of the silver market didn't change on Friday, not one bit. The supply and demand equation is exactly the same today as it was last Thursday. Silver has been in a supply deficit for 5 consecutive years now. Every single year since 2021, more silver has been consumed than mined. The cumulative deficit, the total amount by which demand has exceeded supply, is over 800 million ounces. That's nearly a full year of total global mine production that simply doesn't exist anymore. It's been consumed, used up, turned into products that won't be recycled. Industrial demand is absolutely exploding and shows no signs of slowing down. Solar panels use silver. Electric vehicles use silver. Every smartphone has silver. Every computer has silver. AI data centers require massive amounts of silver. Military systems, from missiles to radar, use silver. Medical devices use silver. And all of these industries are growing, not shrinking. The demand is accelerating year after year. Meanwhile, supply can't keep up. There have been no major new silver discoveries in years. The ore grades at existing mines are declining, meaning you have to process more rock to get the same amount of silver. It takes approximately a decade to bring a new mine online, even if you find a massive silver deposit today. Environmental regulations are getting stricter. Production costs keep rising due to energy prices, labor costs, and equipment expenses. It's getting harder and more expensive to pull silver out of the ground every single year, so we have demand rising, supply constrained, and a growing deficit. None of that changed because of one day's crash. The deficit is still there. The demand is still growing. The supply is still constrained. The fundamentals didn't blink. They're exactly the same. What changed on Friday was a paper price, a number on a screen, a number that's controlled by futures contracts, by margin requirements, by the rules of an exchange that can be changed at will. Paper prices can be manipulated through the mechanisms we've discussed. Physical supply and demand cannot be manipulated. Reality always wins in the end. After the 1980 crash, silver eventually recovered. It took 31 years, but it did recover and went on to make new highs. After the 2011 crash, silver eventually recovered. It took 13 years, but it recovered. Both times, after the manipulation, after the crashes, after the margin hikes and forced liquidations, silver went on to make new highs. The physical reality of supply and demand eventually reasserted itself. They can suppress prices. They have the tools to do it. We've just witnessed those tools in action. But they can't suppress prices forever. Eventually, physical reality wins out. It always does throughout history. You simply cannot fake supply and demand forever. The gap between paper promises and physical reality can only stretch so far before it snaps back. The question that nobody can answer, not me, not the smartest analysts on Wall Street, not anyone, is timing. When will it snap back? Will it be months? Years? Nobody knows for certain. Here's what I know for certain based on documented facts. The CME raised margins 4 times in 6 weeks, and silver crashed 37% in the final week of that sequence. This exact same pattern has played out twice before in the last 50 years. Both times, silver eventually recovered and went on to exceed its previous highs. China controls most of the world's silver refining capacity, and they just implemented export controls on it. This means they can restrict how much refined silver leaves the country. Meanwhile, America and Europe crashed the paper price. Think about that strategic positioning. Central banks around the world are selling U.S. treasuries and buying gold at the fastest pace we've seen in decades. They're voting with their reserves. They're showing you what they think about the future of fiat currencies versus hard assets. The physical silver market was already showing signs of stress before Friday. Premiums on physical coins and bars were rising, even while paper prices were stable. Now it's even worse. The gap between paper prices and physical availability is wider than I've ever seen it. Try buying physical silver right now at $75. You'll pay $80, $85, maybe $90, depending on the product and the dealer. That spread tells you everything about the disconnect between paper and physical markets. What I don't know, what I cannot tell you with certainty, is whether $75 is the bottom. Could silver go down to $60 to $50? Yes, it absolutely could. The paper price could be pushed lower if they want to. Could it bounce back to $100 next month? That's also possible if buyers step in aggressively. Nobody knows for sure, and anyone claiming certainty about near-term price action right now is either lying to you or trying to sell you something. But here's what stays with me, what I keep coming back to. If silver truly doesn't matter, if it's truly just an outdated relic from the gold standard era with no modern relevance, why do they keep doing this? Why run the exact same playbook 3 times in 50 years? Why coordinate margin hikes right before massive price crashes? Why does the CME care so much about the price of what they claim is just another commodity? They say it's risk management. They say it's for market stability. They say they're protecting traders from excessive volatility. But look at what happened on Friday. Traders got absolutely destroyed. Billions in losses. Entire accounts wiped out. Years of carefully accumulated gains gone in hours. Retirement plans devastated. Dreams shattered. They're not protecting traders with these actions. They're protecting something else entirely. The dollar, the system, the narrative that paper money actually works and holds value. The fact that they keep doing this, the fact that 3 times in 50 years they've crushed silver whenever it started to run too far too fast, the fact that they simply cannot let it trade freely without intervention, that tells you exactly what silver threatens and exactly what they fear. Actions speak louder than words. The intensity of the response reveals the magnitude of the threat. In 1980, they told you they crushed silver to stop the Hunt brothers from manipulating the market. In 2011, they told you they raised margins to ensure market stability and prevent a bubble. In 2026, they're going to tell you this was just a healthy correction, normal market behavior, nothing unusual to see here. Just move along. But you can see the pattern now, can't you? The margin hikes carefully timed during the rally, the coordination across multiple hikes in a short time frame. The playbook from 1980 and 2011 being run again with minor variations. China accumulating physical metal while America dumps paper contracts. Central banks choosing gold over treasury bonds. De-dollarization accelerating globally. The BRICS nations working on alternative payment systems. You know what they don't want you to understand? The paper price says silver is $75 per ounce today. But paper is just a claim, a promise, an IOU that can be manipulated through margin hikes, that can be defaulted on, that can become worthless if the counterparty fails. Metal is real. It exists in the physical world. It can't be printed by a central bank. It can't be hacked by cybercriminals. It can't be frozen by any government. It can't be margin called out of your possession if you hold it physically. They can crash the paper price through the mechanisms we've discussed. They cannot crash the metal itself. It still has all the same properties, the same industrial uses, the same scarcity. They can liquidate futures contracts. They cannot liquidate physical silver sitting in your safe. They can manipulate paper markets for years, maybe even decades, but they cannot manipulate physical reality forever. History is genuinely irrelevant in the modern digital financial system. Why would they need to do all this? Why raise margins 4 times in 6 weeks? Why run the exact same playbook across 50 years? Why would China be aggressively stockpiling physical metal while America crashes the paper price? Why would central banks around the world be buying record amounts of gold? You don't fight this hard against something that doesn't matter. You don't deploy the same weapon 3 times in 50 years against something that's irrelevant. The intensity of the attack reveals the value of the target. The effort expended to suppress something tells you how much they fear it. Remember that principle when you're making your decisions about what to do next. Friday wasn't just a crash. It was a message, a reminder to everyone watching of who controls the paper markets, a demonstration of power, a show of force. But it was also something else, something they probably didn't intend. It was confirmation that silver still matters after all these decades, that precious metals still threaten the system in fundamental ways, that after 50 years of pure fiat money, after 50 years of unlimited money printing, after 50 years of financial engineering and modern monetary theory, They still haven't figured out how to make gold and silver irrelevant. They still can't allow these metals to trade freely. They still need to intervene when prices rise too much. And honestly, that might be the most bullish signal of all. Their actions tell you what they fear. And they clearly fear a world where people trust metal more than paper. They called it a crash. At the Wealth Continuum, we call it a crime scene, evidence of market manipulation that follows a well-documented pattern. They called it volatility. We call it the same playbook running for the third time in living memory. They called it risk management. We call it the system telling you exactly what it fears most. 37% in a single day. No geopolitical crisis. No economic data release. No corporate scandal. No news whatsoever. Now you know why. The margin hikes, the mathematical precision of the timing, the playbook from 1980 and 2011, China versus America, paper versus metal, East versus West. A financial war that's happening right in front of us, but that nobody in the mainstream media wants to acknowledge. The data is public. The dates are documented. The pattern is crystal clear for anyone willing to look beyond the headlines. What you do with this information is entirely up to you. I'm not here to tell you what to buy or sell. I'm here to help you understand the game being played, the forces at work, the patterns that repeat. This is the Wealth Continuum, where we follow the money, track the patterns, connect the dots, and help you understand the forces shaping your financial future. If you found value in this analysis, please subscribe if you haven't already. Hit that notification bell so you don't miss future episodes. And share this with anyone you think needs to understand what's really happening in our markets. Thank you for watching, and I will see you in the next episode where we will continue tracking these patterns and following this story as it develops.